Rafael Nadal versus Roger Federer. It's clay, so Rafa does have the advantage, though Federer has beaten him the last 5 times that they've met. Good evening and welcome to News Now. The big story this Friday evening. Yesterday, Governor Shaktikanta Das said that the new circular to replace the highly contentious and now defunct Feb 12th circular would be out in 2 to 3 days. Wasted no time. It's out the very next day. Was issued today at 5 p.m. put up on the RBI website. There's fresh to do with the resolution of stressed loans. RBI has done away with the very contentious one-day default norm and directed lenders to review accounts within 30 days of default and initiate a resolution plan before default. The new resolution plan gives complete discretion to lenders with regard to design and implementation of resolution plans. Ishita Guha joining us live. Ishita, it's been 1 hour since that circular is out. It's technical in nature, of course, a lot to understand and the impact it's going to have. So let me first put it to you that what's changed? What is new? Why is life going to be different for the bankers and the promoters of stressed assets?
So to answer your question, what has changed and what is new in this revised circular, that will come as a breather for bankers as well as large borrowers who probably default on their payments. One is, of course, they have done away with one-day default payment. Remember, this one-day default payment rule was a bone of contention, and both lenders and borrowers were unhappy with this rule because even with one default, they were going into the NPA segment of any bank's book, and that was obviously causing a lot of controversy from both the lenders as well as the borrower side is concerned. Besides that, now that one-day default rule has been extended to 30 days, so there is a 30-day grace period for borrowers to make payment, and they will of course will not be punished for defaulting just by one day. And besides that, the rule of mandating banks to take any defaulting account to NCLT, to insolvency proceedings, has been done away with. In fact, one of the points that has been mentioned in the revised circular, it says that complete discretion to lenders with regards to design and implementation of any resolution plan, which means banks now have the power to design and implement any kind of resolution plan. So they have more power at their hands, which was not the case earlier because RBI had already given in their mandates that any defaulting account will go to the insolvency court. Besides that, one more important point which I would like to highlight here, they have said that wherever necessary, RBI will issue directions to banks for initiation of insolvency proceedings against borrowers for specific defaults. So even as we see that banks and lenders have been given full discretion to design and implement a resolution plan, RBI still has the highest authority, highest power as far as any defaulting account is concerned. And if they feel that there is any lag in resolution plan from the lender sides in any kind of defaulting account, then they will be eligible to intervene, and they will have a say in what kind of treatment should be given to one account. So RBI still has the final power and authority as far as resolution of any account is concerned. So this is one important point. Besides that, a lot of relaxations have come in as far as the one-day default rule is concerned. That has been done away, and mandating banks to take any defaulting account to NCLT has also done away with.
Okay, so stay with us. Let me now go across to Mythili Bhusnurmath, who's been with us right here on ET Now since this circular came out. Nilang Desai from AZB also joining us. Mythili, I know that the circular just came out about 70 minutes ago. We still yet to absorb the fine print. But if I could request you to tell us, and it's exactly what I asked Ishita, this time round, what's different? Yes, we know, for example, that the one-day default is gone. It's going to be, the lenders will have to observe the bad account for 30 days in case there is a default. Are there a lot of changes? Is it, do you think, going to be accepted by industry for being more accommodative, more realistic, and actually fructify in better recoveries?
Well, I hope that does happen. The circular does seem to address most of the issues which were problematic. And best of all, it restores the position as it should be, because remember, ultimately it is the banks who have lent their money. It is not the Reserve Bank of India which has made the loan. So the restoral of complete discretion, and I emphasize the word complete discretion to lenders regarding the design and implementation of resolution plans, is as it should be, because it is as I said, it's the banks who have taken the decision to lend. They are best placed to decide whether any further help should be given to the borrower, whether it should be given some kind of support, or whether they should call in the money. This is not something that the regulator should do. That the referee becoming a player is just not on, to put it in the language of sports. So I think this is very important. It restores the position as it should be because it gives lenders the right to decide. And it says in supervision of all the earlier schemes. Remember, under Dr. Raghuram Rajan, the RBI had come out with a whole host of, it was an alphabet soup of schemes, S4A, CDR, and God knows what else. So these were all getting more and more, on the Reserve Bank of India, getting into the nitty-gritty of lending and do micromanagement, which is never advisable. So now it just gives complete discretion. Hopefully the banks will use this responsibly and will not go back to the earlier situations where they were constantly, throwing good money after bad. Hopefully banks now feel that they do not have to throw good money after bad because post IBC, they have the power to exercise control over borrowers, recalcitrant borrowers, because borrowers also know that banks hold the sword of taking them to the NCLT over their heads. So now that we have better balance between the borrowers and the banks can use this discretion to come up with realistic resolution plans. So that, I think, is a very welcome step. RBI has realized the foolishness, the idiocy of the RBI getting into that. At the same time, they said wherever necessary, and this is as it should be under Section 35A of the amended Act. So that is a fair position to hold. Additionally, RBI has realized that the better way of going about ensuring that the banks comply is not by holding a sword to their head, really, but it's also essentially by ensuring that there are disincentives in the form of additional provision. So in case there's a delay in the implementation of a resolution plan, and they are given a timeline, 30 days for a review period, then again 180 days, the resolution plan must be implemented within 180 days. That means a total of 210 days. So if this does not happen, then banks are required to make additional provision in a staggered way. Initially 20%, then an additional 15%. So RBI is disincentivizing banks from dragging their feet. So this, I think, is again a very welcome step. The withdrawal of the asset classification, what was earlier known as a one-day default, that is also good because now we are again getting it into in line with what Basel had said. That means default will be recognized as the same 90 days. Default will only then will it be treated as a NPA. Otherwise, SMA1, SMA0, all these have been brought in line with the Basel norm. So I think many steps that the RBI has taken, which will hopefully end the kind of dissonance and the tendency of borrowers to take the RBI to the court on the basis of circular. Hopefully, we will now see resolution plans moving faster and both banks and borrowers moving faster to resolve bad loans.
Please stay with us. Let me go across to Nilang Desai as well, who's been listening into Ishita Guha's report on the details of the press release as well as your views. And then I'm going to go across the former Deputy Governor of the RBI, Anand Sinha, who's just joined us. Nilang, let me come to you. You've been tracking IBC so closely. You've been tracking the method of recovery, Feb 12 circular. We've all been talking about why it could not be realistic. There was struck down by the Supreme Court. What is your initial take on the Feb 12 circular? You just heard what Mythili has had to say. We've had a member of the Power Producer Association on the channel very disappointed. But then, the power producers' problems go beyond the RBI. Do you think this is just what was needed for recovery or it falls short?
No, I think it's actually very helpful to my mind because we now have, a system in place which is generic and complies with what the Supreme Court suggested, in the sense that we have the ability to tell banks that this is how you do something in a generic manner without the RBI getting involved on a specific name-by-name basis, which we think is in compliance with what the Supreme Court said. It incentivizes banks to implement a resolution plan of any sort. It may be a restructuring, it may be a sale of exposure to third parties, it could also be IBC. But the point is, get something done, have a policy in place internally, think about it, sign an ICA so that it's not, random action and it's a coordinated action and you don't have minorities holding out and creating nuisance, and then implement it in a specified timeline. I think this works rather well within the confines of the rules and the regulations and the mandate and the diktat set out by the Supreme Court. And keep in mind what it also is What it also says is if you do implement it, then any disincentives I've pushed onto you in terms of provisioning get reversed.
So if I could now come across Mr. Anand Sinha. Mr. Anand Sinha, your initial thoughts. You just have heard what Nilang Desai of AZB's had to say. Do you think this circular will help in recovery? We've seen that process being stalled. We've seen the kind of litigation that has taken place. And something to note, while the contentious one-day default is gone, going by the circular and its wording right now, we don't know as yet, the quorum, how large the quorums of the lenders' approval is needed for the plan, for the resolution plan. On first case reading, it seems to be silent. Have I got that right?
You see, the circular has just come and it has got to be read carefully to look into the nuances. But my first reaction would be two things which I find are definitely improvement upon the earlier circular was bringing in systemically important non-deposit taking, non-banking financial companies into the fold of the circular, as well as small finance banks. So this will cover the default or the stress in the system across more lenders, and that is how it should be. So that is something which is certainly most welcome. The second thing is that, which I find is helpful compared to the 12th February circular, is that the concept of JLF had been done away with, and at the same time, there was no rule regarding for enforcing a resolution plan. Now, I would argue that in 12th February circular, it was left to the banks for them to form their own JLF and to decide on these rules, and that is how you find that under Sashat they were able to formulate a scheme. So I would argue that banks, in fact, had more freedom under 12th February circular in this regard, which, of course, they were uncomfortable with. So to the extent that while JLF word has not been put into the circular, but the fact that they have to come together and a rule has been laid down about what will be the threshold for mandatory implementation of resolution plan, is certainly, from a practical perspective, an improvement over the earlier circular. Now, there is so much of talk about a one-day default having been done away with. My first reading of the circular is it's not so.
Okay, please carry on. Please carry on.
What I'm trying to say is that the one-day default, in my view, on my first reading of the circular, has not really been done away with. Default kicks in once you don't pay on the due date. Now, all that has happened is that they say that within 30 days you have to come out with a resolution plan. And resolution plan does not mean necessarily a restructuring. It also means that you ensure that all the overdues are recovered. And that was the state of affairs in the 12th February circular also. So maybe optically it looks that you have 30 days to take action. But the basic spirit that borrowers have to pay back on the due date, and if they don't pay back on the due date, then you have to get into action and ensure that you get your money back, or if there is a structural weakness, then you put in place a restructuring plan. Is very much a continuation of the earlier circular. Let me read out one line from the detailed circular, which says, since default with any lender is a lagging indicator of financial stress faced by the borrower, it is expected that the lenders initiate the process of implementing a resolution plan even before a default. In any case, once a borrower is reported to be in default by any of the lenders mentioned at some paragraphs above, lender shall undertake a prima facie review of the borrower account within 30 days from such default. So the spirit remains the same, that you have to be on guard, you have to look for signs of weakness. If payment is not made on the due date, you have to get into action. The other thing is that under the Supreme Court judgment, obviously, the mandatory reference to IBC has been done away with. And but still the RBI reserves the power, which is how it should be, because how many times you can restructure, how many years you can drag it, all those things are important. And maybe going ahead, some mechanisms evolves or some rule evolves that we have to wait and see. So these will be my preliminary remarks.
Breaking news, Mrs. Sinha, with what you're telling us that we may be jumping the gun and assuming that the one-day default has gone. Nilang Desai, if I could come to you now. You've just heard what Anand Sinha, the former RBI Deputy Governor, has had to say. The one-day default, we should not be assuming is gone.
No, I think I completely agree with that. I was going to point that out actually earlier. I don't see that the one-day default concept is gone. In fact, after default, there's a review period, it seems, and then after that, there's the implementation of the resolution plan, which you think about during your review period. So I don't see where the thinking is that after default you have a 30-day grace period. I don't see it on the preliminary reading at least.
One and Mrs. Sinha, hi, good evening. Ishita this side. I have a question. Of course, this comes as a breather for lenders also, because now they have full discretion as far as designing and implementing any resolution plan for a defaulting company is concerned. But it says, one of the pointers says that additional provisioning for delay in implementation of resolution plan or initiation of insolvency proceedings. So given the history of resolution, we have seen some cases in fact have taken more than 1.5 years, 2 years also. Some of the cases that were referred by RBI in the first list in June 2017 are still going on and have no resolution in place. So do you think this will be an additional provisioning will add to the burden on the bank's books, and therefore they will continue taking hit on the profit?
That is how it should be, because hello.
Yes, please continue.
That is how it should be, because they have been given a timeline within which they have to come out with a resolution plan. And if they don't do, they have to pay a price for that. I mean, that is how you can ensure that proper attention is paid to weaknesses in the asset portfolio and quick action is taken. You see, the most important thing as far as weaknesses in accounts are concerned is to detect it in time and to take action in time. There cannot be any argument against this. And that is why it is important to build disincentive if somebody is not following this. So if their profitability suffers, if they have to make additional provision, well, they have to pay the price for delay and lethargy in case there is a lethargy.
Revelations that's come in, a lot of us in the media assumed it was gone, but as they always say, devil is in the detail. The corollary of what you've said, would you go on a limb to say the one-day default rule actually stays? Anand Sinha, sir, this question was for you.
Yeah, according to me, the concept of default is linked to the due date. If you don't pay on due date, there is a default. And if there is a default, you have to get into action. You have got a period of 30 days to put the things into action, but it doesn't mean that the concept that you have to pay on the due date has gone.
Is exactly what had bothered and scared industry, that 24 hours is just too small a window to have these kind of invocation that takes place under the Feb 12th circular. Mr. Anand Sinha's reading is that rule is not gone. If that is indeed the case, would you say that this, I think it's a fair assumption that industry would be very disappointed and will want it changed?
No. You see, what I am saying is that the circular still maintains that you have to pay on the due date. If you don't pay on the due date, then it's a default. And all that has happened is that you have got a 30 days window to pursue your plans to recover it. But that's why I read out the circular earlier, which 2-3 lines from the circular, which says even before default, you should take action, but in any case, not later than 30 days. So that is my reading.
Mythili, please come in here. You've just heard Mr. Sinha talk about the detailed circular. He's read out that relevant portion, talking about how that spirit is very much being maintained. So you consider to be a defaulter after just missing a payment for 24 hours, whatever the reason might be. But maybe that needs to be seen in conjunction with the Basel Committee for the financial difficulty. But the difference seems to be that you get a 30-day window to try and arrive at a resolution. What do you make of this, Mythili?
Yes, Anand is right, because if you look at the definition of what constitutes SMA 0, 1 and 2 in the earlier circular of February 12th and the new circular of 8th, that is RBI issued today, the definition stays exactly the same. That means the moment you do not pay, between 1 to 30 days, you become SMA 0. SMA 1 is between 31 and 60. The only difference is that, as Anand says, you get a 30-day review period. So effectively, you get some breathing space. So even though you get classified as an SMA 0 and it is treated as a default if you don't pay on time, there is an additional review period of 30 days which is not there, to my mind, in the earlier circular. So in effect, a resolution plan has to be implemented within 180 days of the end of the review period. So you get a total of 210 days. So that is what makes a difference. It gives a little bit of a breathing space. So I do not think, obviously I think the borrowers are not going to be very happy about this. But the fact is that it is a slightly improved situation as compared to earlier. It is not so rigid. At the same time, it does not dilute the entire credit discipline. And that is a position as it should be, because borrowers should understand that when a loan is due, they have to pay on the due date.
I'll give you the final comments. You have a lot of clients. You're going to have to explain the circular to a whole host of people, I'm sure, later half of this Friday evening, whatever's left of it, and tomorrow. Having said that, we've just broken down how the one-day default rule perhaps stands, but you get a grace window, 30 days, to try and arrive at a solution. Resolution has to be worked out within 180 days. The IBC also has very tight timelines. Put everything together. When you juxtapose all of this, are you seeing a significant change, significant breathing room, which didn't exist after the last circular? Nilang Desai, this was for you. Okay, I'll come back to Mr. Anand Sinha. Anand Sinha, I'll come to you for the final question. We've been talking about, Mythili and I've been talking about this on air since 5 o'clock. The very fact that, the Feb 12th circular talked about 100% approval. Since you've read the detailed circular, is there any change in that? Is there any definition of a quorum of the bankers that need to sign off on the resolution plan, need to agree to?
Yes, exactly. In fact, in my opening remarks, I said that in the earlier circular, the concept of JLF had been taken away and there was no mention of any quorum as such, and therefore the interpretation was that that it required 100% consent. But actually, that was not the case. It was left to the banks. What the 12th February circular said was that it was left to the banks to come together and decide on all these issues. And in that context, I mentioned Sashak, where this kind of rule had been laid down. So while these are all not in black and white, but this is my interpretation of the earlier circular, that it was left entirely to the banks. But practically, maybe things don't work that way. So this time, while the word JLF has not been used, the banks have been asked to come together, and a rule has been laid down about how much by amount and how much by numbers lenders should agree for a resolution plan. So yes, from a practical perspective, that is welcome.
Mythili, is this very, very quickly, because we have to wrap up the show, would you say this is that this could help, that this clarification, which is then the detailed circular, in the past, let's be honest, the Joint Lenders Forum hasn't been very successful?
Well, yes, Anand is right once again that this now you have specified that the ICA, the Intercreditor agreement, has now been made mandatory. That means that, and this is in fact most of the bankers have done this. So now you don't have an option. It's not voluntary. It is mandatory. And provided that 75% of the bankers by value and 60% of the bankers by number agree on a resolution plan, the resolution plan will go through. And the remaining lenders will have to be content with the liquidation value. So this makes it much easier because in large consortium advantages, typically true of large accounts, you might have one stray lender who doesn't go along with the other lenders. And that could create a lot of problems. So now that we've specified a very definite number, hopefully the resolution plan will be faster to come to an agreement. And now we have a very definite deadline and additional provisioning for banks. So to pressurize banks also into going in for faster resolution. Hopefully this will kind of set the controversy at an end and we will see faster resolution under the IBC process.
Okay, with that, we are completely out of time. So I'd like to thank all of my guests for joining us here on ET Now to break down the RBI circular, the new one issued today at 5 p.m., what it means for the banking landscape, for the promoters of assets that have gone down. And remember, all of this is going to have a cascading impact on the economy. When you have higher recovery, of course, your credit offtake increases. Then a lot more we will keep discussing right here through this evening on ET Now. My thanks for watching.